Good morning, everybody, and I hope you can hear me well. A big welcome, everyone, and thank you very much for joining us today. My name is Simon Greaves, and I'm a partner at BDO in Financial Services, and I also lead the BDO Evaluations team responsible for financial products and derivatives. I'm joined today by my colleague Mark Spencer, who is our accounting advisory leader for financial services. Before we start, the first thing I wanted to say is that from all of us at BDO, we hope that you and your respective teams, families, and loved ones are safe and well during these very difficult and challenging times. Before we kick off, I wanted just to touch on some simple housekeeping points, if you don't mind. Firstly, today's webinar is going to be recorded, and we will circulate the slides and the recording later. And secondly, all your telephone lines will be automatically muted throughout the webinar, so don't try and chat. In relation to questions that you might have, please submit these to the panel throughout the session using the Q&A box at the bottom right-hand side, and please ensure that you send questions to all panelists. We will, of course, try and cover as many of the questions as we can at the end of the webinar. And finally, if you've got any problems with the sound, please let us know via the Q&A box. So without further ado, I'll now pass over to Mark, and I hope you both enjoy the presentation and find it informative and educational. Mark, over to you.
Simon, thank you very much. And good morning, everybody, from me. I am Mark Spencer, as Simon said, and I lead our financial services accounting advisory practice at BDO. First of all, thank you from me for joining us today for this webinar. Financial services accounting advisory at BDO spans all aspects of accounting and financial reporting across 5 pillars, with these pillars being accounting change, structuring advice, financial instruments, accounting and reporting, climate and corporate reporting, and all other areas of accounting. One thing that the financial services accounting advisory team at BDO has been doing as interest rate benchmark reform progresses is engaging with financial reporting and prudential regulators in the UK and the EU, trade bodies, our peers, both locally and internationally, and other parts of the wider community on the accounting for the implications arising as a result of the reform under international financial reporting standards and generally accepted accounting principles in the UK. We have run webinars on the first phase of accounting amendments for interest rate benchmark reform that focused on pre-replacement issues in 2019 and earlier this year. Today's webinar focuses on the second phase of proposed accounting amendments, that is to say, those that deal with replacement issues. In terms of agenda, for the time that we have today, we will be providing some context on the current status in terms of standard setting, and then talk through the proposed amendments to existing accounting requirements that the International Accounting Standards Board is currently contemplating. This will be across modifications of financial instruments, hedge accounting, other standards that are being amended, and those areas of accounting that are also being amended and why. On hedge accounting, we will also be considering transition, given some of the proposed amendments are applicable for a period of time and only a period of time. And as I said, on those areas of accounting that are not being amended, we will provide some insight into why. On financial instruments, including hedge accounting, we will also provide some thoughts on the additional disclosures that are required in light of these proposed amendments. But first, where are we? The IASB issued an exposure draft that focused on replacement issues on the 9th of April 2020 that had an accelerated comment period of 45 days, which closed on the 25th of May 2020. The IASB board and its staff have been working very quickly, even through COVID-19, so as to introduce accounting change given the wide-ranging effect of interbank offered rates, which are colloquially known as IBORs. Replacement issues are those that affect accounting and financial reporting at the time that the reform takes place. That is when an IBOR is replaced with an alternative risk-free rate. Examples of risk-free rates are SONIA, ESTA, and SOFR. The proposed amendments, which in the main provide relief from an existing accounting requirement, span modifications of the contractual terms of financial assets and liabilities, hedge accounting, lease contracts, and disclosures, as well as specific amended requirements of I-39 financial instruments recognition and measurement. The latter, i.e., the modifications to the requirements of I-39 financial instruments recognition and measurement, only applies to insurers, and we'll explain why later on in this presentation. These proposed amendments amend current accounting requirements that arise as a direct consequence of interest rate benchmark reform. The amendments, when issued, will be effective from 1st January 2021. That is not 1st January 2020, as the IASB does not issue standards, amendments, and interpretations and make them applicable for reporting periods that have already commenced. Early application is encouraged, but the European Union does need to endorse these amendments once they have been issued. The UK is still bound by the need for EU endorsement of IFRS until the Brexit transition period ends, and we withdraw from the EU formally and fully. Furthermore, the amendments, when issued, can only be applied early in IAS34 interim financial reports once they have been endorsed by the EU. The amendments are mandatory for annual reporting periods beginning on or after 1st January 2021, and their application is retrospective when it comes to hedge accounting. The responses to the consultation, that is the exposure draft, were deliberated at the June IASB board meeting, and we will be sharing insight from changes to the proposed amendments that were discussed at that June IASB board meeting. It is expected that the amendments will be formally issued in August. And we'll be pausing throughout this presentation for any pertinent questions from the audience. We also have some time at the end of this presentation for questions. And Simon, I'll just take a pause here to see if we have any questions. Okay.
We don't have any at the moment, Mark.
Okay, thank you, Simon. And moving on to the modifications of financial instruments. At the moment, when faced with a change to a contract underlying a financial instrument, one needs to assess whether this modification is substantial or not in both qualitative and quantitative terms. A modification is typically substantial when the carrying amount under the new terms is 10% more or less than the carrying amount under the original terms. A modification is typically substantial in qualitative terms in light of the type of change or changes. If substantial, one de-recognizes the original financial instrument and recognizes a new financial instrument, with the difference being recognized in profit or loss. This proposed amendment is a relief from this test, whereby, if and only if the changes are a direct consequence of interest rate benchmark reform, then this test does not apply. The proposed amendments also clarify that this relief includes the activation of a clause in terms of a contract, such as a fallback provision. And it also includes changes to the basis on which the interest benchmark rate is determined, which would arise with respect to SONIA later on this year. This last point is as long as the change in basis is economically equivalent. That is to say, there is no transfer in value. So, what are direct consequences of interest rate benchmark reform? These are outlined on your screen and include replacing the word GBP LIBOR with SONIA, USD LIBOR with SOFR, and Euribor with ESTA. As stated a minute ago, changes to the basis on which the interest benchmark rate is determined to constitute a direct consequence of interest rate benchmark reform, as is adding a spread. This is because IBORs are typically at a higher rate than alternative risk-free rates, as they contain an element of credit risk that banks factored in to what they would lend to each other at. Therefore, the proposed amendments allow for moving from LIBOR plus 2% to SONIA plus 3% if the difference between LIBOR and SONIA is 1%. Changes to reset periods and dates, as well as number of days between payment dates that are driven as a result of interest rate benchmark reform, are considered to be a direct consequence, as is the adding of fallback provisions to reflect any of these aspects. The proposed amendments allow for the application of relief whereby the change is treated as if it were a change in a floating rate of interest. Changes in floating rates of interest give rise to a change in the interest rate and an equal change in the cash flows. When the changed cash flows are discounted back to present value using the changed interest rate, the impact is nil. That's to say, there is no adjustment to the carrying amount. If more changes are affected to the contract underlying a financial instrument than those that arise as a direct consequence of interest rate benchmark reform, then one first benefits from the proposed relief and then applies the requirements of IFRS 9 financial instruments on recognition and derecognition. And as I said earlier, the exposure draft comment period closed on the 25th of May, and the IFRS International Accounting Standards Board deliberated this at their June board meeting that was held 1 month later. And we are providing some insight of what the IASB board deliberated a few weeks ago. So, sticking with the topic of modifications of financial instruments, these are the proposed amendments on modifications of financial instruments as they stood in the exposure draft. At its June meeting, the IASB board tentatively decided to finalise these proposed amendments without substantial changes. However, the IASB board also tentatively decided not to extend the proposed amendment to address issues that interest rate benchmark reform present in relation to IFRS 9's contractual cash flow test and derivatives embedded in financial instruments. IFRS 9 has a contractual cash flow test, which means that the repayments of the debt assets are solely payments of principal and interest, which is colloquially known as SPPI. Interest is defined as being compensation for time value of money and credit risk. IFRS 9 also has a concept known as modified time value of money, whereby the interest resets periodically to an interest rate that has a tenor that is different to the interest reset period. For example, the interest resets monthly to 3-month LIBOR. This is colloquially known as a constant maturity swap, which is a derivative that is embedded in a debt asset host. In such instances, one needs to assess 1-month LIBOR against 3-month LIBOR and determine if this difference is significant. If it is, then the contractual cash flow test is not passed and the debt asset is measured at fair value through profit and loss and not amortized cost or fair value through other comprehensive income. Some alternative risk-free rates only reset on an overnight and backward-looking basis. However, they may then not contractually reset daily, but monthly, quarterly, and so on and so forth. The likelihood of there being a difference is therefore higher, which is expected to result in more debt assets being measured at fair value through profit and loss. Remember, the IASB board has decided not to amend IFRS 9 requirements in this respect. And before we move on to hedge accounting, I'll just take a brief pause here to see if there are any more questions from the audience.
Looks like nothing so far still, Mark, so please crack on.
Okay, thank you very much, Simon. We will do. Moving on to hedge accounting amendments. Similar to the modification of financial instruments, hedge accounting can be changed given interest rate benchmark reform under the proposed amendments without giving rise to discontinuance. This applies to both hedge designation and hedge documentation. And this is important relief because it means that you would not need to discontinue your hedge accounting relationships. Practically, one can amend both hedge designation and hedge documentation once or twice, as interest rate benchmark reform can be affected to the derivative before the hedged item and therefore the hedged risk. And the relief in terms of not discontinuing when amending hedge designation and hedge documentation again only applies to those changes as a direct consequence of interest rate benchmark reform. There is also relief in terms of hedge effectiveness testing under IAS 39. Remember, under IFRS 9, one can still apply the hedge accounting requirements of IAS 39. The IASB has allowed this until its dynamic risk management project is completed. And another thing to remember, you could be applying fair value hedge accounting to the interest rate exposure of a portfolio of financial instruments under IAS 39 and designating all other hedge accounting relationships under IFRS 9. We will revisit hedge effectiveness testing under IAS 39 in a few minutes' time. In terms of what happens at the point in time that the hedge designation and documentation is amended, is outlined in the proposed amendments. And this covers both cash flow hedge accounting relationships and fair value hedge accounting relationships. For fair value hedges, the hedging instrument and or hedged item are remeasured using the alternative risk-free rate, with the difference that arises being recognized in profit and loss. That is to say, the gain or loss arising on the measurement of the hedging instrument and the hedged item under a fair value hedge. Entities will need the infrastructure and valuation capability to estimate the fair value using both the InterBank Offered Rate and the alternative risk-free rate. For cash flow hedges, the reserve is remeasured based on the risk-free rate to the lower of A, the cumulative position on the hedging instrument, that is the derivative, and B, the cumulative change in the fair value hedged item. And again, it is important to stress that entities will need to consider their current infrastructure and valuation capability to estimate the fair value of derivatives and hedged items using both InterBank Offered Rates and alternative risk-free rates. Sticking with cash flow hedge accounting a bit, amounts accumulated in this reserve are deemed to be based on the alternative benchmark rate when the hedge designation and the hedge documentation is updated. This includes amounts accumulated in the reserve that have been previously discontinued but were not recycled to profit and loss because, for example, the hedging instrument expired or was sold, terminated, or exercised, but the forecast transaction is still expected to occur. So, cash flow hedge accounting involves the taking out of a floating to fixed interest rate swap, and the derivative may have been terminated. However, the future cash flows are still expected to occur, and therefore you would retain the effective portion of the hedge in the cash flow hedge reserve in other comprehensive income, and then we classify that to P&L as and when those forecast transactions occur. With these amendments, the reserve is reclassified to profit or loss when the forecast transaction occurs based on the alternative benchmark rate. And on group of hedged items, the proposed relief acknowledges that interbank offered rates may transition to different risk-free rates at different times and allows for the requirements to be applied at a subgroup of items level vis-a-vis the hedged risk. There is also a proposed relief for designation of risk components. This is when part of the interest rate is hedged, even though it is not contractually specified. Typically, these risk components need to be separately identifiable as at hedge designation and each measurement date, with each measurement date being at least each reporting date. So if you report twice a year, half year and year end, then you have at least 2 measurement dates. With the relief, one can now assume that the separate identifiable requirement is met, provided there is expectation that it will be separate identifiable within a period of 24 months from the date the alternative benchmark rate is designated. One might ask, why 24 months? Is this not an arbitrary number? The reason for this is that we are now in July 2020, and benchmark rates need to be reformed by 31st December 21 at the latest, which is less than 18 months away. And if alternative benchmark rates do not satisfy the separate identifiable 24-month criteria due to a lack of liquidity, then they are discontinued. On hedge effectiveness testing, cumulative fair values are to be reset to 0 at the point of the reform. However, hedge ineffectiveness continues to be recognized and measured in full in profit or loss for both fair value and cash flow hedges. If the alternative benchmark rate makes the hedge ineffective because, say, the result of prospective effectiveness testing is out of the IF39 AT125 corridor, then that hedge accounting relationship is discontinued. The proposed amendments are mandatory and respective with effect from 1st January 2021. Prior periods are not required to be restated under the proposed amendment to reflect their application, but they may be restated if and only if it is possible to do so without the use of hindsight. Doing so would mean that hedge accounting relationships that were previously discontinued solely due to changes directly required by interest rate benchmark reform are to be reinstated. If an entity does not reinstate prior periods, the entity shall recognize any difference between the carrying amount, the previous carrying amount, and the carrying amount at the beginning of the annual reporting period that includes the initial application of these amendments in open retained earnings as at the date of initial application. So, to state that a bit more simply, if you're not restating prior periods, then you would recognize any difference on 1st January 2021 for 31st December year ends if the amendments are not applied early. If they are applied early, that is from 31st December 2020, then, and you do not restate comparatives and reinstate previously discontinued hedges, then you would reflect the difference as at 1st January 2020. At this June meeting, the IASB board tentatively decided to finalise these proposed amendments with some changes. And I say tentatively because we are still waiting for the final amendments to be issued, as I said earlier, sometime in August this year. These include examples of amendments arising as a result of interest rate benchmark reform, which include portions of designated hedged items. And that changes have to be effected by the end of the reporting period, during which the uncertainty with respect to a specific element associated with the hedge accounting relationship has been resolved. It has also been clarified that the board, by the IASB board, that the 24-month period for risk components applies to the alternative benchmark rate when designated, and that discontinued hedge accounting relationships are only reinstated if they were solely discontinued because of interest rate benchmark reform, with all other hedge accounting qualifying criteria needing to be met. With the 24-month period, in this instance, beginning from the amendment date of initial application. Finally, on hedge accounting, the IASB board clarified that the relief is still available as long as the hedging instrument is not derecognized and the outcome of the manner in which the derivative is amended is economically equivalent to modifying it to refer to the alternative benchmark rate. This is because it might be market practice to actually tear up the old derivative contract and replace it with a completely new contract. So the IASB board wanted to cover this off such that this will not give rise to hedge discontinuance if doing so was economically equivalent to modifying the derivatives contract to refer to the alternative benchmark rate. And that's what we have to say about hedge accounting. And before we move on to disclosures, I'll just take another brief pause to see if we have any questions from the audience.
Yeah, Mark, we've got one question on this, and it is as follows. So you've spoken about making changes to effectiveness testing, and whilst we appreciate this is a webinar on accounting, how could one theoretically do this? Are any methods prohibited?
Okay, thank you, Simon. I think that there are 4 ways in which one could make changes to effectiveness testing. Firstly, one could mirror the change in the hedging instrument in the hypothetical derivative as one moves from, say, GBP LIBOR to SONIA. The hypothetical derivative represents the perfect hedge of the hedged risk in the hedged item. The difference in the hedging instrument and the hypothetical in this first instance would be equal and opposite and therefore offset. There will be no impact on hedge effectiveness, and there will be no impact on the measurement or recognition of ineffectiveness. Secondly, one could restrike the hedged risk in the hypothetical using SONIA instead of GBP LIBOR. This would give rise to a difference that is recognized in profit and loss, given one is using a different rate to estimate the fair value of the hypothetical derivative. Thirdly, one could adjust the fair value of the hypothetical with the movement so as that there is no change in fair value overall, but the hedged rate used would change as a result. This could give rise, again, to a difference that is recognized in profit and loss. Fourthly, one could theoretically go back in time and calculate the fair value of the hypothetical as if the hedged risk had always been based on SONIA. This is operationally complex, and I would not expect somebody to do this in practice. The first way, i.e. the mirroring of the hedging instrument change in fair value in the hypothetical derivatives fair value, is less principles-based and does not feel to be within the spirit of accounting requirements. The fourth way, that is remodeling the hypothetical as if the hedged risk was always the SONIA rate or the alternative risk-free rate, could be used to prove the first. That is to say, that there is no value change. And I'll just take a pause here to see if that fully answered the question, and also to see if there are any more questions.
Yeah, there's another one that's come in. There's 2 actually. Does the reset to 0 affect the pre-hedging amortization adjustment?
Okay, and this applies to, I assume that this relates to fair value hedge accounting, because under fair value hedge accounting, you have a fixed rate hedge item, to a fixed rate mortgage, and you have a fixed to floating rate derivative interest rate swap. And what you're trying to achieve here is you're trying to carry that fixed rate mortgage at a floating market rate of interest, and it shows, because that is more reflective of what a market participant would pay. And what happens in this case is you would recognize gains or losses on the derivative in P&L with a broadly equal and offset difference in fair value of the hedged item. And I say broadly because ineffectiveness would be not manifested in your hedge risk. So it wouldn't be reflected in your hedged item. And when you're doing that, what you're effectively doing is you're adjusting the effective interest rate with fair value changes in the hypothetical derivative. And the amortization will exist when you have those hedged items on the books. So when you reset to 0, what happens is you will have one hedge accounting, fair value hedge accounting adjustment, which is captured in the carrying amount of the hedged item and will continue to unwind on some systematic basis. And then you will start again effectively from scratch with the new hedging instrument, and you'll then start to accrue for the fair value hedge accounting adjustment, and then start to unwind that on a systematic basis as well. And this is not dissimilar to when you would, for example, restructure a cash flow hedge relationship, whereby you have one cash flow hedge reserve, the original cash flow hedge reserve, that remains in your other comprehensive income, and you would reclassify to profit and loss as and when the forecast transaction occurs. And then you'd be recognizing a new cash flow hedge reserve for the new derivative. And you would then again reclassify that as and when the forecast transaction occurs. Hope that that answered the question. So you would effectively have two fair value hedge accounting adjustments in relation to the hedged item that would amortize based on systematic basis. And I'll just take another pause here to see if there are any more questions in terms of hedge accounting.
Yeah, there's one quick one, which is, do I have to change all the documentation relating to designated hedges?
Okay, so under the relief, you're allowed to make certain changes that would not give rise to discontinuance. And those changes are solely those that arise as a direct consequence of interest rate benchmark reform. So you do need to change your hedge documentation for that. It does depend what your hedge designation documentation says. For example, it may refer to the benchmark rate rather than LIBOR. If it refers to the benchmark rate, then you don't need to change the designation documentation because you're still referring to a benchmark rate, just using SONIA. However, if it says LIBOR, you would need to update it to say SONIA. However, if you are making any other changes that are not a direct consequence of the reform, then that would give rise to a de-designation and a redesignation. And similar to what I was just talking about in terms of having two cash flow hedge reserves or two fair value hedge accounting adjustments that you need to amortize, you would have that in that instance whereby you're amending your hedge designation for changes that are other than those that are a direct consequence of interest rate benchmark reform.
Thanks, Mark. There are a couple more, but I think we should just crack on and maybe cover these at the end, if that's all right.
Okay. Thank you. A couple of points of new disclosures that relate to financial instruments. Firstly, these include disclosing the nature and extent of risks associated with interest rate benchmark reform, how the entity is managing them, how the entity is progressing vis-a-vis transitioning to alternative benchmark rates, and how that transition is being managed. At its June meeting, the IASB board tentatively decided to finalize these proposed amendments with a clarification, with this clarification being my second point. That is, the entity is required to separately disclose quantitative information about non-derivative financial assets, non-derivative financial liabilities, and derivatives that, at the end of the reporting period, remain referenced to an InterBank Offered Rate or InterBank Offered Rates. So you're going to have at least three categories if you have financial assets, financial liabilities, and derivatives that are linked to LIBOR, GBP LIBOR. You could have six if you have those three that are linked to both Euribor and GBP LIBOR. So as I said, this is to be disaggregated by significant benchmark rate, and the entity is to choose and explain the representative basis on which the quantitative information is being disclosed. In terms of other proposed amendments, the IASB is amending two areas. The first is IFRS 16 leases, which had similar modification requirements to IFRS 9. Lease rental payments may be linked to an interest rate benchmark. For example, you could be paying LIBOR plus something, a fixed amount when it comes to lease rental payments. In such instances, direct consequences of interest rate benchmark reform are again treated as if it were a change in a floating rate of interest, whereby the discount rate is changed, as are the cash flows with no change in the carrying amount of the lease. So it's basically, you just update the rate, you update the cash flows, and you have no change in the carrying amount. Insurers can still apply IAS 39 instead of IFRS 9 by virtue of amendment to IFRS 4 insurance contracts. This is until IFRS 17 insurance contract is effective, so as that insurers need only go through a big balance sheet change once. And this is because IFRS 17 amends the requirements for the liability side of the balance sheet quite significantly and associated reinsurance balances, and IFRS 9 amends the financial asset side of the balance sheet quite significantly as well. So this proposed amendment allows an insurer to apply the IFRS 9 proposed amendment to modifications of financial instruments under IAS 39, as that is the financial instrument accounting standard that insurers are applying. And at the June meeting, the IASB board tentatively decided to finalise these two areas of proposed amendments without substantial changes. And on those areas that the IASB has decided not to amend, some insight as to why. Firstly, insurance contracts under IFRS 17. IFRS 17 becomes effective on 1st January 2023. Insurance contracts, particularly those with saving elements, may refer to benchmark rates. However, it is not envisaged that the fulfillment cash flows that are then discounted back to present value would change substantially as a result of interest rate benchmark reform. And this is partially, for example, because of the existence of insurance risk and other non-financial risks such as morbidity, mortality, and longevity. I would also add here that benchmark rates should be based on alternative risk-free rates in good time for 1st January 2023. Secondly, no amendments have been made to requirements relating to changes in discount rates that are used to determine accounting estimates. This is because such would constitute a change in accounting estimate under IAS 8 accounting policies, changes in accounting estimates and errors, with that change in accounting estimate being accounted for prospectively. This may give rise to a one-off impact in profit or loss, or a more long-term one, such as when estimating value in use for goodwill impairment testing under IAS 36 impairment of assets. It is worth noting that accounting estimates may not change, though, as a result of interest rate benchmark reform, as while the IBOR component of the discount rate may change, for example, it may decrease, other components may change as well, and they may increase to offset the impact of the move from a IBOR to an alternative risk-free rate. Finally, on this slide, IFRS 13 fair value measurement. No changes have been proposed or subsequently made to the measurement and disclosure requirements of IFRS 13. The accounting estimate that is fair value may similarly be different on a longer-term basis, or there may be a one-off impact as a result of interest rate benchmark reform. This may also give rise to, for example, fair value level higher gauges in some circumstances, given the interest or discount rate is less observable. So you may see a movement from level 2 to level 3, for example. So, a lot to take in. And as one can see, interest rate benchmark reform impacts accounting, but not only so. It also impacts valuations and operations, given differences in rates, methodologies and processes, with systems also needing to change as a result. There are tax implications as well, given it affects financial position and performance, with the need for an overarching governance, risk and controls framework to be in place, as well as governance of the products that one offers. And with the best will in the world, errors will unfortunately be made, and customers will unfortunately not be treated fairly, with associated heightened conduct risks. So, what should you be thinking about and doing? First of all, identify whether and which transactions and balances will be affected by interest rate benchmark reform by benchmark rate, and then assess the nature and extent of the impact that the amendments will have on your transaction and balances, as well as the timing thereof, given different InterBank offered rates are being reformed at different times. For example, ESTR is being reformed more quickly than SONIA and SOFR are. Have a strategy for modifying the contractual terms of financial assets liabilities and do so knowingly of those changes that for which the proposed relief can be availed of and those changes that for which it cannot be. In a similar vein, review recently discontinued and current hedge accounting relationships, as well as consider the designation and setup of new hedge accounting relationships that hedge benchmark rates on either a fixed to floating basis or a floating to fixed basis. This is so as that you are able to reinstate discontinued hedge accounting relationships where possible, which will require the maintaining of two sets of measurement basis and calculations for a period of time. Decide on the approach to update and apply hedge effectiveness testing and measuring ineffectiveness for recognition thereof in profit and loss, and start preparing the disclosures that are required by the proposed amendments at a disaggregated basis so that the information is to hand when you come to prepare your financial statement. And this includes areas of critical accounting judgment, such as applying the separately identifiable requirements that we talked about a bit earlier in terms of risk component. And finally, your auditor will be interested in a number of things, including understanding your InterBank Offered Rate linked exposures, as this derives the extent of the changes which will arise as you transition to alternative risk-free rates. They'll also be interested in how this impact in rates, changes in rates and methodologies is being assessed and implemented, and how you are interpreting and applying these new accounting requirements. The governance, the process and controls will be an area of interest as well, with new ones expected to be designed and implemented in light of interest rate benchmark reform. And auditors undoubtedly will be interested in how all of this is being disclosed in the financial statements, including how information useful these disclosures are to the users of the financial statements. And as I said, with the best one in the world, given the sheer complexity of all of this, given the sheer size of the IBOR market in trillions, there is an increased likelihood of disputes and claims. So in short, your auditors are interested in how management is responding to interest rate benchmark reform. There are resources on both interest rate benchmark reform and accounting, financial reporting, and corporate reporting on our UK and global websites. There are Simon and my contact details on the screen should you want to discuss this or any valuations, risk, financial operation, conduct, accounting, financial reporting, or corporate reporting matter further, as well as the contact details of Ariel Grosberg, a banking assurance partner, and David Britton, a banking tax partner, who are members of BDO's UK Interest Rate Benchmark Reform Leadership Team. But may I remind you that the slides and the recording of this webinar will be circulated in a couple of days' time, and you will have our contact details in that slide pack that is sent to your email or inbox. And on that note, I thank you very much for your kind attention. I hope that you found this useful and that you continue to keep safe and stay well. We will now take a few more questions. Simon?
Yeah, we have a few. So the first one is just to cover off on pre-replacement issues. So the question really is, can you provide a little bit of colour on the pre-replacement? Let me read this properly. Could you perhaps provide some colour on pre-replacement issues?
Sure. In a nutshell, amendments that were issued on pre-replacement issues relate solely to hedge accounting and instances whereby an IBOR was the benchmark rate and they applied to no other area of accounting. They enable hedge accounting not to be discontinued solely because of volatility in LIBOR markets across a number of areas of hedge accounting, which are similar to those dealing with replacement issues that we spoke about in this presentation, such as group of items and risk components. This is because increased volatility in LIBOR is expected as interest rate benchmark reform progresses, which could have unintentional impacts in terms of effectiveness. So, to summarize, these pre-replacement issues were addressed through an amendment issued towards the back end of 2019, and the IASB did that in response to concerns that there may be hedge discontinuance purely because of LIBOR volatility as a result of expectations about market reform and the uncertainty surrounding that market reform. So those are very helpful reliefs that would not give rise to hedge discontinuance until one would have certainty on the outcome of the reform and they would transition from the IBOR to the corresponding alternative risk-free rate.
Thank you. And another one, can you briefly summarise the difference in impact between our IFRS and UK GAAP accounting? We've covered a lot about IFRS.
Okay. The Financial Reporting Council, which is the national competent authority when it comes to UK GAAP, have an exposure draft that is currently doing the rounds on replacement issues. They have issued amendments on pre-replacement issues, which were broadly similar to those issued by the IASB. The exposure draft that is currently being consulted on is, again, broadly similar to the IASB. This time around, the FRC waited for the IASB to make a fair degree of progress with their proposed amendments on replacement issues before issuing its consultation draft. That consultation draft has an extended period because of COVID-19, so it goes out until September. But the thing with UK GAAP is we don't need to wait until endorsement by the EU because it's the gift of the UK government to issue UK GAAP, FRS 1 and 2. So it covers broadly the same areas. The underlying requirements themselves as they stand are a bit different, but it addresses changes relating to modifications of financial instruments as well as hedge accounting. And just bear in mind that the hedge accounting requirements in UK GAAP are a IFRS 9 light version of hedge accounting, but it doesn't have all the extensive detail. When it comes to leases, I'm not aware of changes proposed in that respect because UK GAAP at the moment does not have the right of use asset lease liability model that IFRS 16 has, so it's less relevant, and also insurance contract accounting under UK GAAP is still largely similar to pre-IFRS 17 UK GAAP, IFRS, sorry. So not many changes expected on that front.
Very good. Thank you very much, Mark. There's another one here. So will we need to take account of changes in the move to a new reference rate through P&L? What if the new rates makes my hedges ineffective? Well, I mean, if you move from, let's say, LIBOR to SONIA, and then there is volatility. So let's say you're applying IAS 39 and you've got the 8125 corridor. Under the replacement issues, if you can show that you're outside of the 8125 and your hedge rate is LIBOR, then you can continue to apply hedge accounting if that difference is solely in relation to the uncertainty relating to LIBOR as a rate. However, once you then transition to the alternative risk-free rate, if you fall outside of that 8125 for whatever reason, then you would have an ineffective hedge, and the normal requirements for an ineffective hedge would apply. So that means you'd have to discontinue that hedge accounting relationship prospectively. Very good. Another one. How would the identification of accounting for modifications work in practice? When are those contractual modifications when those modifications include some that relate to interest benchmark reform and some that do not?
Okay. I'll illustrate by way of an example. Say you have a loan that is being contractually modified from GBP LIBOR plus 0.5% to SONIA plus 0.5%. But the fixed spread is being increased by 1% because of the difference in GBP LIBOR and SONIA, as SONIA is more risk-free than GBP LIBOR. So you're moving from GBP LIBOR plus 0.5% to SONIA plus 1.5%. At the same time, let's say the borrower asks for the term loan to be extended with some reduction in monthly interest payments, and the lender says, okay, I'm happy to do that, but as compensation, I need a further 2%. So this latter change, extending the term of the loan and reducing the monthly payments and a further increase in the interest rate of 2% are not a direct consequence of interest rate benchmark reform. So one would apply the proposed relief for those contractual modifications that arise as a result of interest rate benchmark reform by updating the interest rate in the cash flows, so moving from GBP LIBOR plus 0.5% to SONIA plus 1.5%. You'll increase your interest rate by that. You'll increase your cash flows by the same amount. You'll discount back to present value. No difference in the two. Nothing recognized in profit and loss. One would then compute. Sorry, Simon?
I thought you finished. Apologies.
No. One would then compute the new carrying amount using the extended term and the revised monthly interest payments and discount them using the SONIA plus 1.5%, but not the further fixed spread of 2%. And you compare this new carrying amount to the original carrying amount post updating the interest rate from GBP LIBOR to SONIA and increasing the fixed spread by 1%. And typically, if the difference in these two carrying amounts is greater than 10%, then one would derecognize the SONIA plus 1.5% loan and recognize a new SONIA plus 3.5% loan at fair value. So if you're a lender, you would do debit new financial assets, credit old financial assets, with any difference being recognized in profit and loss. And the converse would apply to a borrower. They would debit old financial liability, credit new financial liability, with any difference being recognized in profit and loss. And what I've just prescribed is set out in financial liability section of IFRS 9. There is no prescriptive guidance in this area for financial assets, though in certain cases you can analogize to the 10% test for financial liabilities if it is considered to be appropriate. And that's what I had to say in response to that question.
Okay, very good. I think we've got time for one last one. I'm conscious that it's 25 past now. This is quite a thorny one, so that's why I thought I'd ask this one, because she's come up. There's been some discussion about the new rates not satisfying the 24-month identifiable period because of the lack of liquidity. What happens if this is the case?
Well, I mean, the IASB has said that you would work on the basis that it would be separately identifiable within 24 months from the point of designation. Now, if you're all of a sudden changing that judgment, i.e. you're saying that it's not going to be separately identifiable for the non-contractually specified risk component, then I don't think you have much of a choice other than to discontinue. I mean, as I said, the reason for coming up with 24 months is because where we're at now, and the expectation and regulators around the world are pushing for interest rate benchmark reform to be finalized as quickly as possible. So the IASB has formed the view that 24 months is a sufficiently long process to enable it for SONIA, ESTA, SOFIA, and so on and so forth to be separately identifiable. And as I said, unfortunately, if it's not, then the normal requirements are set out in IFRS 9 and IAS 39 will apply.
And I think we also have to wait and see if liquidity actually generates itself as we move forward in time as well.
Agreed.
So thanks very much for that, Mark. I think we're going to come up to the sort of wrapping up now. So I just want to finish off by firstly saying there are a couple of questions we haven't got round to answering, but we will, of course, do so after this, in due course after this webinar. And thanks again for those that have submitted questions. Fantastic. It's always good to make things a little bit more interactive, particularly when we're having to do things via a webinar type environment rather than be able to actually see you. Also, as we mentioned earlier, we have recorded this webinar and we will send you a copy of this and the copy of the slides as well in the coming days. And finally, I just want to thank Mark for presenting today and for all of you for joining us. I hope it's been informational. I hope you've got something out of it. It's a tricky topic. There's a lot to take in, as Mark said. But thanks again and have a safe and great remainder of your day. Cheerio. Thank you very much.